started, okay? So, I'm very happy you came over here. Let's start with the reward risk ratio. And I always use this slide, this sentence last time, because I think what we need to do as traders, we cannot trade like everybody else. If we were not successful, 95% of the people are losing money in the markets. I believe it's more than 95%. I have the chance very often with brokers. I collaborate with a lot of brokers. Lately with AxiTrader, still collaborating with them. They're FCA regulated. They're not far from here actually. And I see how people trade, and it's really very bad. So the problem is that Einstein said insanity is doing the same thing over and over again and expecting different results. He didn't say that's just whatever, that's a bias. He said that's being insane. So if you want to get different results, you need to change your paradigm. You need to change your model. A paradigm is a way of thinking, a set of beliefs, a set of core beliefs, right? A set of core actions. Because beliefs bring action, right? And you need to change your paradigm, and that's my purpose. My purpose is at least to shake your old paradigms, maybe to give you some new ideas so you can create a new paradigm around trading. And we do it with expert advisors, with the FX method, because we believe that you have to have consistency. We believe that you have to have figures that are tested in a very long run back test, normally 10 years, and you must be certain that the strategy or the system is really working in the past in order to be certain that it may work in the future. So that's the syllabus for today. I hope I can manage in 45 minutes. Actually less, we should do this in 30 minutes in order to have questions and to have a practice at the end. I'm going to show you 3 back tests, and we're going to calculate what's the reward risk ratio, okay, how it's properly calculated and what we can do with it. Because it's having the reward risk ratio for no purpose, that makes no sense. We want to do something with it, right? So we will define first why it's a misnomer. Then we will define 3 different types of ratios, which people really mix with each other, and they're very different, which is the departure ratio, the maximum ratio, and the average ratio. And they're very different. And we will see this in a back test, right? But it applies to manual trading as well. All of this, it's applicable to manual trading. Then we will define the different types within a ratio that we could have, which we call, that's special about us, we call them long ratios, short ratios, or medium ratios. And they will give us a hint what trading family we're trading. Normally in trend systems we will have always, not always, in pullback systems we won't, but in all other trend systems we will have long ratios. In scalping systems we will have always short ratios, and the other families of systems like range systems, some breakout systems, they will be medium ratios. You will see it's very easy, and I couldn't manage to print the document. Whoever wants to have the document later, the Excel I will show you, I can send it over. Just write your email down here, and you'll get it in your email, in your inbox. Okay? So, and then we will explain what is really truly being above the water. Why we need the reward risk ratio to be certain we are above the water, and how much above the water we are. The question is not to be above the water over here, we rather want the water down here, right? And we will calculate it precisely, and this is applicable to anything. You can audit your trading account, for instance in my FX book, or in MT4, or FX Blue it's called now, or any other statistical software, and you can calculate this, and you should calculate this. And if you have different styles of trading, you should apply it to all of them, okay? So, first of all, we need to define the animal. What is it? And why is it wrongly called the risk-reward ratio? In accounting, we always divide by costs. That's one of the first things I learned when I was studying economics. I studied economics as well. And in a balance sheet, it's obvious that that which is below, which is divided by, is actually the cost. It's actually the risk. It's actually the penalty, right? And the rewards are always in the balance sheet on the upper part of the division. right? And so it makes absolutely no sense mathematically to put it upside down. And you may say, well, it's the same if we know what it is. No, it isn't. Because we do it properly. We say, we divide rewards by risks. Always. And when I'm talking a 2-to-1 system, I mean something else than the usual traders are meaning. When I'm saying 2-to-1, I mean 2 times reward, 1 time risk. And it's very messed up in the industry. You know, people say, what do you trade? I trade 1 to 2. But what does it mean 1 to 2? You mean the stop loss is 1, the take profit is 2? It's not, there is not a standard. And when you're saying risk-reward ratio, actually, in the wording, you are implying that the risk is above the numerator, right? And the reward is in the divisor. But it makes no sense unless you're doing creative accounting, like Emerald, right? But I hope nobody here is doing creative accounting with his own trading, are you? You got that, no? It's very fashionable now, creative accounting. States do that. You know that, right? They included, just as an anecdote, they included in the European Union as well as in the UK, prostitution and drugs into the GBP. That's really creative accounting. I wonder how they measure that. No? Do they have policemen counting? How many guys turn into this place? How much is spent? What kind of service? Sorry for the bad joke, but you understand? It's very usual, like creative accounting. So we shouldn't do that. I mean, we can have cognitive dissonance with anything, but not with our own trading account. You got that? So let's call it from now on the reward risk ratio. And when we mean that, we mean rewards are upstairs and risks are downstairs. And that's it. And that makes sense. So when we're talking, are you trading a 2-to-1 system? I know he's trading. And if he says, I'm trading a 1-to-2 system, I know he's scalping. He's more scalping, he's more trading. But otherwise, I don't know. I need to ask one more question. What do you mean by 1-to-2? I mean blah, blah, blah. You see? So that was really, for me, shocking as a mathematician when I started to hear people and they're messing up. You understand? Okay, so that's about the definition. Everybody understands that. That's clear now. And what's very important is that both possibilities, meaning that I have a bigger figure upstairs or a lower figure, a bigger figure downstairs, they both make money. And I was amazed, I'm not going to say the book, hedge fund trader, one of the top algorithmic traders in the world from the United States. I'm not going to say the name because you should, when you criticize, you should be polite. But people saying that you shouldn't trade anything, which is at least not, it should be at least 2-to-1. And I say, and what about 1-to-2? That means it's forbidden? Because yes, this guy that runs the hedge fund and has all these fantastic books otherwise, and then you can ask me privately, who is it? I'm not going to say it now, is saying you can trade short ratios. And I wonder, why not? Can I not trade a 1-to-2 system which should give me at least I should be 66.66% of the times right. If I'm being 75% of the times right, can I not trade it? I wonder, then I can go scalping. By definition, this forces all investors to trade trend systems. That's what they want you to do. They want you to be in the market. A little fish should stay in the pond as long as possible, because the longer he stays, the higher the chances are he will lose everything. You understand that? I'm trading everything. I trade trend systems, I trade scalpers, everything. It's logical. So both possibilities are profitable. I can have 2-to-1, 1-to-2 systems, 3-to-1, 1-to-3 systems, 4-to-1, and 1-to-4 systems. And I can have 1-to-1 systems as well, or 1-to-1.5 systems, or 1.5-to-1 systems. You can trade everything. It depends on the success rate. That's all it depends on, right? That's what you need the reward risk ratio for. We are so used to saying risk reward, I'm almost not even trained to say the right wording. So that's a wrong myth. It's a wrong myth that you can only trade long ratios. A long ratio is when the take profit is much more than the stop loss. I should actually write it with a double. It's written with a double sign, right? Much more, right? And a short ratio is when the stop loss is much more than the take profit. And there's a set of liars out there that say, well, you know what? I do scalping. I've heard it in London, I've heard it in Italy, I've heard it all over the place. They say, I put my stop loss at 10 pips. So you're a liar. If you're putting your stop loss at 10 pips, I've done so many scalping systems. I've tried so many scalping systems which were developed by other people. It never worked out. If I have the stop loss at 10 and I go for 10 pips, which is a 1-to-1 ratio, right, in scalping, I will hit the stop loss much more than 50% of the times. It's statistic. It doesn't matter if you're trading the ducks. Oh, and then they say, no, yeah, but I put it visually. So what? Visual stop loss. You know, it means I have an imaginary line in my mind. You know, that's not a stop loss. That's a scam. That's, you know what I mean? You cannot trade 1-to-1 in scalping. Period. It doesn't work out. Try it. Run a back test 14 years. Don't believe me. Okay, so you need short ratios. If you're scalping, you're going for 4, 5, 10 pips, points, whatever, cents, if you're talking brand or whatever, right? You need a further stop loss than the take profit if you're scalping. Always. By definition. Okay? And we have a subset of trading styles which I developed. I just categorized them this way because I understood that there's years, for instance, 2012, where the market is really lateral. It doesn't trend. You know, normally trending happens 20% of the time only, right? So we have this myth that the trend is your friend. And I wonder, somebody, if it would be your friend, right, it wouldn't be absent 80% of the time. I mean, what kind of friend is that? I mean, you know, you call a friend, right? And I wonder, I ask people, do you have the WhatsApp of Trent? You know? No, nobody has it. I mean, it only happens 20% of the time on average. But there are years, it only happens 10% of the time. And you're with your bloody trend system, right? Trading, and you hit the stop loss all the time. And you wonder, what's happening? Well, it's not a trend year. It's not a trending year, right? So you need to trade this. You need to trade that year medium ratio systems. You need to trade what's exactly in the middle, which is 1-to-1, 1 to 1.5, 1.5 to 1. That's the medium. You have sits over here. You can sit over here. Yes. Okay, so, and I found out they trade great on those years. So I divided them in 3 categories, right? I divided it in the long ratio. The profit is much higher than the stop loss. Short ratio, the stop loss is much higher than the take profit. And the medium ratio, the stop loss and the take profit are similar. Similar, not equal, right? Examples. There's, for example, a bond out there, accumulator. It's actually arranged. It's a commercial bond. Okay? It trades like 50 points, stop loss 28, 29, 30. That's a medium ratio. Everything which is between 2-to-1 and 1-to-2, okay, it's a medium ratio system or medium ratio strategy. Okay, and it's fantastic for lateral markets when the markets are not trending. So we have now 3 different ratios. That's also a big confusion out there. I'm speaking about another one. And actually, I was not very precise when I was saying take profit against stop loss, because that's only the departure ratio. Let's imagine, for instance, I call it the fork system. The fork system is just a stupid, plain manual trading system, usually, that has just a simple stop loss and a take profit, and no exit rule in between. So either you win 20 pips, or you lose 40 pips, and nothing else. There is no trailing in between. There is no break-even routine. It's just either losing or winning. That's it, right? Many people trade like this. And you are leaving a lot of money for other traders, because the smart thing is, first, you have a departure ratio. You decide, by the way, you shouldn't put the stop losses too far away in scalping, would you? I mean, I've seen people putting the stop loss on 120 pips for scalping, and I was like, what? And you're going for 10 pips? You're talking, your departure ratio is 1 to 12. We'll be talking about that, right? Oh, great. So if it's 1 to 12, you need to be only 95% of the times right. Good for you, you know? And it's a way of scamming, because it's like, I tell the people, you know what? If you're putting the stop loss at 120 pips, why don't you just put it at 400? You will hit it even less. Now, we'll be talking about this, because it's very tricky, because the scale can go up as much as I want. I can have a 10 to 1 system, I can have a 20 to 1 system, but I cannot have a 1 to 12 system. I just simply cannot trade it. And I would tell you in the short ratio, what's the limit? Because there is a limit to it. You cannot trade anything beyond 1 to 5. Actually, you should be trading beyond 1 to 4. And I will explain you why. Because there is a limit to the success rate. I mean, you cannot be 99% of the times right, can you? There's a ceiling, which is 100%, right? Unless you live in another planet, then maybe you can be 120% of the times right. But not here. The ceiling is 100%, right? Yeah, I mean, go out, but some people don't see this. So if you're trading, let's say, for example, there was a bot out there. Everybody was buying it. It was called Overdrive. It was trading on the cable. And it had the stop loss 300 pips, take profit 10. And people were crazy about it. And it was even doing martingale. Not just one entry, 1, 2, 3 entries. What happened was, it was trading great on a live account for 6 months. It never hit the stop loss, right? That's a very good way to scam people. You see, you're trading 1 to 13. You say, wow, look at this. 98% of the times right, 100%. Yeah, it never hit the stop loss. Wait. When you get one wrong, you need 30 good ones. You'll never make it. You'll never make it, period. Beyond 1 to 4, you'll never make it. So the departure ratio has a limit. The departure ratio shouldn't be beyond 1 to 4, 1 to 4.5, 1 to 5. That's the maximum you can have in the short ratio. But in the trend system, you can afford anything. You could go for 1,000 pips and have your stop loss at 20. That would be 50 to 1 in the long ratio. If your trade is good, let's wait for Monday. You should be trading today. Sorry, yesterday. I'm on Saturday. I thought it was Friday. I was watching the charts yesterday. Today's closed. Okay. You should be trading yesterday. You should be out of the markets completely. You know that, right? Mm-hmm. Okay, good. So, departure ratio is the starting point. That's the maximum limit, right? That's the fork. And in between these 2 points on the fork, let's say you are in a buy trade, that would be the stop loss, that would be the TP, and that's the entrance point. That's why I call it the fork, right? It doesn't make sense. So a fork system is a very stupid system. And the departure ratio should be always, in a good trading system, different from the average ratio. If your departure ratio is 1 to 5, and your average ratio is 1 to 5, that means you have a stupid system. Because you're trading fork. What does it mean not to trade fork? It means, like, imagine you are risking 50 pips, right? And you're going for 25 pips. That's a 1 to 2 system, right? And imagine half of the times on the losing side, on the downside, you'd be closing at 0 with a break-even routine, right? Then you'd be trading 25 to 25. Because half of the times you are at 0, and the other half you are at 50, the average is 25, minus 25. You see that? So what you're looking for here, is that clear, the concept? We're improving the fork systems, and how can we recognize that? Is that the average ratio is different from the departure ratio. Once we got that, we know automatically that there is a smart trader there, that there are smart additional rules there on the downside and even on the upside, right? You see that? You could have a trend system. Let's put it the other way around. I need to check the time because I like to talk. You know, you could have a trend. Oh, we're very short. You could have a trend system, right? And you could have a TP of 1,000 pips, and you could have a stop loss of 20. Does it mean you will hit 1,000?
No.
No. You will have a trading stop. Sometimes you will exit at 100 pips, sometimes at 150, sometimes at 200. The question is, what's the average? The departure ratio is 100 to 20. That's 50 to 1. That's the departure ratio. But the average ratio, maybe on average you exit at 200. So your average ratio is 10 to 1. Your departure ratio is 50 to 1. Your average ratio is 10 to 1. You need really to dominate these concepts. You need to see examples of your own trading, of other people's trading, and calculate both. You got that? And people confuse them. I don't give a damn about the departure ratio. Only in order to compare it to the average ratio to see if the system is improved and became smarter on the way. You got that? And then we have another ratio, which is the maximum ratio, which is the extreme case. You could have a system which is stop loss 20. You can make pictures, no problem. You could have a system which has the stop loss 20, TP 1000, but you put it on last Friday, and Macron is not going to win. I hope yes, but who knows, right? And you don't have a stop loss of 20, you have a stop loss of 500. And then you have another ratio, which is called the maximum ratio, which includes all the black swans, all the situations of the real market, all the slippages, right? All the reality, and you get another ratio. In this case, you would have 1,000 against 500. And you need to take this also into account, right? Because if you have the stop loss too tight and they're not respected, especially in the stock market, if you're trading stocks, equities, and sometimes in the futures as well, in the future market, your stop loss are not going to be the ones you put very often, right? Forex market is kind of, if we exclude the weekends and if we exclude bad news, right, the stop loss are much more respected. Unless you are in a scammy broker. But okay, let's exclude that as well, right? Should be FCA regulated or regulated in Switzerland. And even then you should check the broker out. But that's another topic for another day. You got that? So, did you understand there are three ratios? And we need to know all three of them in order to know your system. It's like the KYC of a trading system, right? If you didn't do this homework, you can't trade. Because you need to know what's your average ratio, what's your maximum ratio, what's your departure ratio, right? So now we go what they call, you went to school, right? 2 times 2 was? Or only 2 people know this? How can it be? You're traders, right? So I call it the traders multiplication table. And that's what I can send you. It's not neat. It's a pity we just did it at 4 in the morning in the office before catching the plane. Should be that more beautiful. But it's very simple. We have here, it's not that neatly done, and we're going to make it more beautiful before sending out. We have here what we call long ratios, right? TP is bigger than the stop loss. We can have 5 to 1, 4 to 1, 3 to 1, 2 to 1, or 2.5 to 1, or 3.2 to 1, you understand? That means that the winners, oops, there's a mistake there, the winners are much bigger than the losers. And if you have a 2 to 1 system, you need to be 33% of the times right. If you have a 3 to 1 system, you need to be 25% of the times right. Right? And here we have the middle ratio, which is everything between 2 to 1 and 1 to 2. Right? 1 to 1, you need to be 50% of the times right. And imagine you just don't have a calculator. And you calculated that you have a ratio of 2.5 to 1. I just get the middle figure. I just get 25, 33. What's exactly the middle of these two figures? That's 8. Right? What's the middle of 8? That's 29%. So I just do it here. I don't take the calculator. Too lazy. So you know that's what we call the break-even. That's the break-even point, we call it. And you need to know what's your break-even, and you do this calculation only for the average ratio. That's the only one which matters here. You understand? People take the departure ratio and make the calculation of the departure ratio. That's stupid. Do you follow? Because the departure ratio is not what you get at the end. You may exit before. You should exit before the trade, on the downside and on the upside. You shouldn't be waiting for the stop loss on the TP. Never. Never. Both in manual and in automated trading. Right? You should exit before. So, you take only the average ratio for this calculation. Okay? And once you have it, you calculate, you subtract the success rate you have from it, and you get in percentage how much you are above the water. And this figure, which I invented, it's in no book, it's nowhere. I read so many books about algo trading, and nobody explained this. That's an absolute figure, which means, imagine you have a long ratio system, which means you are on the table. I'm not going to jump on the table now, you see, because it's not very stable. But imagine I'm a long ratio system, I'm on the table, and the water is here, right? The mouth is here, right? And I'm below the table, that's a short ratio system, and the water is here, and my mouth is here. The difference is the same, is it? Meaning, if you have a 2-to-1 ratio system, and you are 38% of the times right, 38.33% of the times right, you are 5% above the water, are you?
Yeah.
Yes or no?
Yes.
If somebody didn't understand it, raise your hands. I explain it one more time. Everybody got it?
Yeah.
Great. And if you are trading a 1-to-2 system, and you are 71.66% of the times right, how much are you above the water? 5%. And what I found out is that the robustness is the same for both systems. 5% above the water is absolute. It's not relative. 5% above the water is more or less down here. What do you want? A trading system which is so much above the water? Or you prefer a trading system where the water is here? Why would you prefer a trading system which is much more percent above the water than another one? Why? What's the purpose of this? Why did I say the word robustness? Not necessarily, because the profit is calculated by the expectancy, expected payoff, times the number of trades, right?
For variance in the markets.
And to detect when the system is not working well anymore. If you have the water here, when things are going wrong, well, you want the river in London, right? I mean, now it doesn't happen, but in the past, there were problems with the river, right? If the river is too high, what happens? You lose your house, right? So you rather have the river far away. It's the same issue.
But
It's for safety.
It's from the year to year the same market when you test it. So the ratio is going to be different. The same system, the same.
Totally, but you need to know your averages. You need to know, am I above average on the system? Am I below average? That would give you signals when not to trade it. I use it.
Okay.
Imagine the average over 10 years is 38%, or here the average over 10 years is 71%. And this year, you are being 43% of the times right. Go trade it. You are above average. You understand? This figure, I call it the winner's divergence. The winner's divergence, write it down. That's a metric I developed. And it's in no book, it's great you came here, right? It's in some video in our channel, but it's not well explained, it's only in our paid education, so that's a freebie for you guys. Okay, and it's a very important course. We call it the 3 horses, there's other 2 horses, which I'm not going to explain today, which drive your trading. And this is one of the horses. How much you are above the water. That's why you calculated the risk, the reward risk ratio in the first hand, in order to know how far you are from the water level. That's what you need it for. I don't give a damn you're trading 1 to 2, 1 to 3, 1 to 4, as long as I don't know what is your success rate. And I can subtract one figure from the other, right? Does it make sense? Okay, I'm pretty much done with the presentation. I managed, I even came late. Gentlemen, before I couldn't set up. So now we have a little bit of time, we have still 15 minutes to see examples, right? I didn't have the time to take 10 years back tests. I have plenty of 10 years back tests, believe me. I can send them over. I just did 1 year back test because I was lecturing yesterday, as I explained at the beginning. and I didn't have time to do 10 years. So I brought only 1 year, but for the matter of the calculation, it's pretty much the same. A very nice breakout system. Okay, and I just took pretty much 1 year. The back test, I don't know if you are acquainted with MetaTrader back tests. If not, I'm going to anyway real quick. Somebody doesn't know even what MetaTrader is. MetaTrader is the #1 platform worldwide. It's used by 92% of the brokers. I mean, over 3,000 brokers worldwide have a MetaTrader license, right? So we use MetaTrader because of this reason, right? So we do a back test. That's just a strategy. It's programmed. And we just did the back test from January 2016 to February 2017. Okay? Not for any reason. I didn't have time to do 10 years. Okay? But it doesn't matter. We are calculating here. You need to put this in practice. If you take the theory and you don't practice with it, makes no sense. You understand? So, you need to come here and read in this line. It says the largest profit trade, the largest loss trade. What would be this ratio of the largest profit and the largest loss? That would be the maximum ratio. You see that? That's interesting to know. I need to know over the last year, what was the worst? The worst was I lost only 16 pounds. That's nothing. That's a lunch, not even. Right? Sorry?
So it depends where we eat.
Yeah, exactly. I mean, you cannot pay more in London. I mean, in Spain you can pay a lunch with that. In London you cannot. You don't even get a coffee sometimes for that money. No, I'm serious. Just had a coffee down there in Narrow, and it was like 12 pounds. There's a coffee and 2 things. I mean, it's like amazing. Okay, so that's the maximum ratio, which is 66 to 16. Quickly, 4 to 1.
4 to 1.
Very good. 4 to 1. You see that? 16 times 2, 32. 32 times 2, 64. Yes, we don't need a calculator. If I told you to have a calculator anyway. That's a 4 to 1 maximum ratio, which I don't care about. But it's very interesting to compare both, right? Now, the average ratio, that's the crucial part of the story, right? The average ratio is 6 to 14, or 7 to 14 if we round up. That's an easy one. That's 1 to 2. So we have what a difference, right? Wow. And if we go up in the back test, we can see the departure ratio. We can read the stop loss somewhere, I hope. Stop loss, 13 pips. Take profit, 110. It's a very trendy breakout system which has fractals and whatever, trading stop. I don't want to explain the system. I just want to show you the departure ratio is 9 to 1. 9 to 1 departure ratio. 6 to 1 we said. Maximum ratio, 2 to 1 average ratio. For the same trading system. Wow, that's interesting. That means we have very long trades where we make a lot of money. Sometimes, right? And sometimes, on average, we only make 6 pounds. And sometimes we do 66. What a difference. That talks a lot, right? That means that there is a big difference in the upside. So probably there is a trailing stop or something, because the difference is 10 times more. You understand? And I use this. I don't need to know the trading system. I need to know the proportions of the trading system. You can do this with manual trading systems. You can trade any trader here in the room, audit his account, and I can tell you what the flaws of his traders are, just by watching the 3 ratios. Where the trader can improve. I can do this analysis. I train students to do this. You understand? And I can see, oh, his flaw is on the downside. He doesn't exit in time. Look at this. Maximum stop loss, 60 pounds. Average stop loss, 14 pounds. Means there is nothing on the downside. It's really a fork. It's pretty much a fork. Because probably the 16 pounds was a bad Sunday. Right? You understand? They're the same. So I know on the stop loss side, besides I know the stop loss is very close, so it's 13 pips. So I know on the stop loss side, this trader has no intelligence, yes, it's only stop loss. And on the earnings side, this trader is doing the things very well. or this trading system, in this case this bot, right? But I could apply it to a manual trading system. Great. So if we have a 1 to 2 system, I go to the table, I can tell you, you need to be 66.66% of the times right. Just believe me, you can go to the table, but the bot is being 40% of the times right. I'm at 14% above the water. And let me tell you, let me fill you in, at 14% above the water is down there. I will see it coming. It's an excellent trading system. You see profitability, we don't know. Go to bad, it makes a 7%, that's not great for a year. That's just average, 7% for a year. That's 700 pounds or over 10,000 pounds investment. That's not very good, but it's very robust. See the difference? Making good money is not meaning making good money properly.
So would this allow you to leverage your, like the capital because your system is more robust?
Completely. Now with the ratio you can do so many things. Go home, think it over. If you don't ask too many questions, I will give you the email. If it's just one time, one question, reply over email. There are people, and you can ask me this kind of questions later on. Yes, I will give you our email. Normally all guys answering, not me. But I will tell you to forward the emails just one time, not one time per week, okay? And you ask, because it's very interesting what you can do with this. Okay, let's watch another back test, right? We are 40% above the water, right? This is the system how I optimized it today at 3 in the morning before I came over. Because how it was, I didn't like it. You will see it, right? And I said, I need to show a good example. I need to show that you can really be 15% above the water. No, you can. Okay? So it was actually, this was the departing point of this trading system. The curve is quite okay. It made even in the same period more money. That's very interesting. It made a 10%, almost an 11%. The curve is not bad. It looks even better, I would say, the curve. And now we check the ratios. Let's see, what's the departure ratio? Let's start with that one. And the departure ratio over here is stop loss 150, take profit 180. That's a 1-to-1, right? Very different. Same trading system, same year, euro dollar, M30, same thing, same spread, same historical data, actually trader, same broker, no tricks, same thing, right? Same bot, same strategy, okay? Departure ratio 1-to-1. Maximum ratio 156 to 156, 1-to-1, meaning there were no black swans. It traded as it should, 1-to-1, 1-to-1, pretty much the same. But the average is 24 to 146 counting. That's a 1-to-6. And that's forbidden. I'm serious. Somebody heard? I heard that. That's forbidden. You cannot trade 1-to-6 because you need to be so off right. You won't make it over the long term. Over the long run, you'll have so many stop losses. You'll not make money with this strategy. 1-to-6, let me tell you, I need to go to the table. That's a difficult one, I don't know it by heart. But I think you need at least, it's not even in the table, it's forbidden. 1-to-5 was 83% of the times right. Probably 1-to-6 is going to be like something like 87% of the times right. Yes, something of the sort. You see that? And you're buying this kind of bots, this kind of trading styles. When somebody's telling you to trade without stop losses, that's an infinite ratio. Anybody, I'm not naming anybody. I have this in 2 lectures. Enough. Right? No, I'm serious. And they're telling you no stop losses. That's an infinite ratio. You need to be 100% of the times right to make it. On the long run. Do you understand? So that's impossible. So 1-to-6 would be 83%, 85%. How much are you above the water? Maybe at 2-3%? Only at 2%? Same bot. Absolutely not robust. More profitable. Much more profitable. 10, 11%, the other one 7%. What do you prefer? Make more money? Have the water here? Ask them. You can answer. What do you prefer? You probably want more money. That's wrong. I prefer robustness. I want to have this conversation in 10 years with you guys. Maybe in 30 years, if I manage. Right? Nice. Let's watch another system, and I'm going to conclude now, and real fast. Let's watch another system which has the opposite ratio. That's a short ratio, yes. Much more stop loss than take profit, than earnings losses, which should be a more trending system. And that's one of our, we give this system out for free if you open an account with a broker and so on. And I just did real quick optimization, also 10% in the year, right? And we go up here, that's a classical, you will see the graph, classical trend system. And you'll see here the stop loss, the stop loss, the stop loss, 15 pips. Take profit 330. Yes. That's a 20 to 1, right? 20 to 1. Don't say 1 to 20. We got it right now. Yes?
Nobody would trade
Like that.
It's stop
No,
loss.
the bots do.
It's stop loss number 2, right?
Yes, because there's 2 bots in 1. Yeah, right. You've been to my lectures. I remember your face.
Yeah, I was.
Yes.
I enjoyed
You
that.
were a couple of times. I remember your face. And I remember your face, and I remember your face as well.
I even asked you one question.
I'm very sorry we sent out the email yesterday. You can go into our Spanish Facebook, we're having over 1,000 people every roadshow signing up, and 500 people turning in. So much organization, I lectured 10 hours, you guys know that, right? And then we drive, and but I didn't want to miss this opportunity here in London with Simon, right? Okay, so we have this clear, that's a 20 to 1 departure ratio. Very nice, right? Once you get it, you're happy. The best should make 600 bucks in one trade. That's the maximum ratio. Let me put it up so everybody can see this properly. I get 33 pounds stop loss. Nice. That's still at 20 to 1, right? Yes or no?
Yeah.
And the average ratio is 181. Every time I get it right, it makes 180 pounds. Every time I get it right. Classical trend system. And the stop losses are very cheap, 30 pounds. I mean, everybody can risk 30 pounds here, right? If not, don't trade. You should be doing something else. If you cannot lose 30 pounds, you're in the wrong business. No, because I've seen people, they lose 1 account, 2 accounts, 3 accounts. When they're at the 5th account, they become extremely conservative. That's the opposite. The total opposite of too high risk, too little risk. Okay, so 181 against 30, that's a 6 to 1, right? And on a 6 to 1, I go to the table. That's the purpose of the table. And I don't have to go to the table, I need to expand the table in order to deliver to you, right? But I need to be right more or less, I would say at 12% of the times, more or less. And the system is right. You see, only with the 12% you make money. It's a 22% of the times right. That's 10% above the water.
Yeah, but psychologically, this is a nightmare to run the system like this.
I tell you what, psychology is so diverse. Some people love trend systems because they psychologically, they say, when I win, I make a party with my wife. You understand? And they don't care about 50 losses in a row. I agree with you. I'm with you. I like the scalping systems because I'm 70% of the times right? And only a few times I'm wrong, but the times I'm wrong, I lose more than I earn. You know what? You should trade both together. That's the answer. So that's a very robust system. If you don't make the calculations, you don't know. You need to know your ratio. And you need to know especially your average ratio. So this was it. Questions? I hope it was worth for you. Questions? No questions? That's bad.
Still processing.
Still processing, that's good. Okay guys, whomever wants the table, just write down in clear letters. Name, last name and email. Okay, it will stay with us. We don't forward this. And it should be readable, okay? If you want that. I'm gonna put the slide with my data, with our data. Yes, if you're interested to know more. This was in one mortgage last year, and this is our Skype, and this is our email. Okay, I don't know if you can see that. Okay, here you go. You can add us on Skype, and you can write down the email. If you have one question, or a set of questions one time, I'll gladly answer them. Okay, if you're writing every week, I'm not going to answer them. Okay, you're welcome. Thank you. Yes, okay. Guys, just write down your email if you want to have it clear. There's no questions?
You have no questions, sir?
I don't know, because I have now the opportunity to go to Germany, Berlin, and it's very appealing, you know. I love London, but I love Berlin as well. So it's very difficult. I'm not trader that is 50% of the time trading and only 40% of the time lecturing. You know that, right? I told you guys who know me. So I'm not so visible. You know, I need my time to develop my stuff, to develop my bots, to be in my lab, and Paul had the chance to come several times to the lab. I want to talk with him, if you don't mind. He did 5 days.
How long have you been trading with your own money? You know, like about
10 years.
10 years.
Well, it's a lie, 9.5.
Okay.
Because I stopped half a year on the 7th of May 2010 with the Greek crisis. I got a big hit.
How many losing did you after 10 years?
The proportion, I would say, is 50 to 1. 50 losing years for 1 lot. That's the proportion. You need to test a lot. Because the fairy tales, you have the fairy tale of the fox, right? The princess kissing the fox. Yeah, you have that.